Last episode, Luke, you posed a very simple question and kind of uncomfortable even in that sense. Do we even really want housing prices to fall? And so this week, I wanted to flip that around a little bit and look at a whole nother country entirely.
Japan interest rates rising?
Oh, that sounds good.
That's take a good that one. Why don't you take that one?
So as you were saying, Japan has been in the news quite a bit again, Japanese interest rates, their FX rate. What I wanted to do was just as briefly as we could, give a little bit of some historical foundation, talk about what has happened over the past 5 years or so since COVID had begun, and what that might mean for the future.
Yeah, let's do it.
So the story that I want to tell today is that from an economics perspective, Japan has been a very strange story. Basically, our entire adult lives, they have been grappling with zero interest rates, deflation, and a central bank doing increasingly bizarre monetary experiments, just all to convince people that prices might go up someday. Said differently, it's been this singular focus now for decades in Japan to have the return of inflation. It sounds kind of weird in today's day and age, but for the past 3 decades, Japan has had the opposite issue, not that prices are increasing too quickly. They weren't increasing at all or even decreasing over very long periods of time. But in the past 5 years, they seem to have gotten what they've asked for. Their CPI has returned to about 3% for the past 2 or 3 years now consistently. So now the question I wanted to pose is, what now? What are the effects that we've seen so far, and where might we go from here? If we rewind time about 35 years or so, we can talk about one of the biggest and wildest asset bubbles in modern history. So usually when we think about bubbles today, we think about the US housing market. Before that, about 15 years prior, we had the Japanese real estate market, which inflated so quickly, so fast that at one point people were saying that the land underneath the Imperial Palace in Tokyo was worth more than all real estate in California. So things got pretty bad at that point.
Or good, depending on how you look at it.
I mean, good for the Japanese government, right? Whoever's owning that.
Yeah, I know. I'm still thinking back to my thesis last week of how great it is to have higher prices for housing. But point taken. Yeah. That seems like a lot. California, no less. Yeah. All of it combined.
What's with this shirt you've got on here?
Oh, Luke? You like it? Yeah, no, this is, I had this for a while. Yeah, no, my wife got it for me.
Wow.
Yeah, we got little custom-made sweatshirts. We don't have a merch store or anything yet. She just got it for me. But yeah, I said, throw it on.
So the history again. So what led up to this insane housing bubble was after World War II, basically from the 1950s into the 1980s, you had really rapid economic growth, a lot of technological innovation, booming exports, overall rising standard of living. That's the main one. I was trying to just,
80s anime, man, peak.
That's What's your favorite?
I'm kind of joking. I'm just trying to think of things I know about from Japan, and definitely a lot of cultural stuff. Culturally, a total powerhouse. Akira kind of stands out. I watched that just because I heard it was just such a classic, and it doesn't really stand up. Not to get too sidetracked, of course, but the amount of time and stuff they put into the animation, it really shows. It's really impressive. You can take that sort of perfectionist cultural mentality or something and apply it to animation, and it really shows. Really beautiful. Must have been blowing people away in the 80s. Now it's with computers, it's not as, but man, it still stands well. Anyway.
Yeah, I mean, I would even argue that, it's just speculating at this point, but kind of the same threads that enabled something that interesting to occur, that really great animation, really great storytelling. It's that level of craftsmanship, and that really shown a lot in that era. You look at the some of the biggest brands coming out of Japan at that time, which was refined and made so much better. Toyota, Sony, all of the the Walkman.
Oh yeah, that's right. Yeah, electronics, right? Yeah, of course.
Mm-hmm. That was a huge part of it. Yeah, cars and electronics, the exports around the world just brought in so much money for Japan. So they started buying real estate, and everyone started buying real estate. So kind of the same thing that happened in the U.S. at 2008, but their economy didn't really collapse in like such a dramatic Lehman Brothers moment like we had in the US. It just sort of started lagging, just gradually slowed down for decades. It was called the lost decade at first, throughout the 90s. From the 2000s, it still didn't change. By the 2010s, we're thoroughly within the lost decades at this point. Amid the falling asset prices and all that kind of stuff, what was seen as one of the most damaging things was the opposite of inflation occurring. So they had real deflation that it was back and forth between zero inflation and then bouts of falling prices and then stabilizing, but never really increasing. And this happened over a period of decades where prices just kept drifting downward. As a result, wage growth was flat to negative, and this is a very debt heavy and aging society. So when you're in a world where everyone, governments and individuals and corporations alike are more focused on paying down debt rather than spending or investing for new ventures, economic growth is just going to totally grind to a standstill. That was the primary concern, this deflationary spiral that just never seemed to end.
Man, that's brutal. I mean, the way you kind of described an aging society and then burdened down by debt just got me back to that thing I freak out about all the time here, which is the debt levels here. And I think it's analogous to just a huge weight that you're just shackled to. Debt. I mean, it just slows you down. All that money you got to spend is just going to paying back stuff you already spent and not anything forward looking. And yeah, it slows you down.
What's over 200% is their debt to GDP ratio. The US has, relatively recently cracked 100%. That seems insurmountable. Like if you were to take the US's debt and now multiply it by about 2.5 times, relatively speaking, that's where Japan is at today. So it's pretty scary.
Yeah. And other people could look at that and kind of hand wave away all the concerns that we vocalize a lot on this podcast, which is to say like, oh, if you think 100% is bad, well, Japan has got twice that and they're doing okay. And they don't even have a reserve currency. So we could take this puppy to 500%, there's no real, no one really knows what the number is, especially for a reserve currency. So it's uphill battle kind of fighting for this debt sustainability and stuff, but it doesn't feel right.
It really doesn't, but that's a great point. It's like, we all know it's bad, but
how far can you push it? We don't know.
Only one way to find out.
Well,
print some more money.
Right. It's just, God damn, is that really an experiment you want to be taking? You know what I mean? It's just like, is this a question you want to constantly be asking? Just take a step back. Let's just take a step back.
What do you know about Shinzo Abe?
Oh, I've heard of the Abenomics. I've heard of the 3 arrows. I think he was assassinated, right?
He was, unfortunately, in 2022. But he came to power as prime minister, I believe, in 2012. And yes, the big thing that he ran on was what became known as Abenomics. So after about 2 decades of these lost decades, so into the 2010s here, kind of the idea was enough is enough. It consisted of 3 main layers, and they all needed to work together in tandem. So the first was just huge monetary stimulus, a monetary bazooka, if you will. Really intense quantitative easing from the Bank of Japan. They bought up such an extreme amount of the total JGB market, as well as yield curve control. This was a new topic in a similar way that the Fed in the United States sort of quote unquote invented in a way quantitative easing. Yield curve control takes this a step further. Rather than saying we're going to buy this many bonds and we're going to tell you how many we're going to buy, we're going to buy as many as we need to get long-term interest rates to 0. So it's as if like in the US we said all of a sudden, you know what, mortgage rates 6% is too high, we're going to make them 2% now. That's that. We're just going to make it happen. How? They're going to go through the central bank. They're just going to buy bonds so aggressively interest rates are forced just to go through the floor. And, as a result, mortgage rates. So that was the first big arrow. Then the second was in tandem with monetary policy is fiscal policy. So fiscal stimulus, basically lots of government spending to juice up demand in the economy, get people moving, get people spending again. And then the last was structural reform, more or less bring about new ways of doing business within corporate Japan to not emphasize saving and keeping prices flat so much. It's long been seen as a kind of an issue, sort of something that you would have to apologize for to raise prices in Japan. And that goes for selling things as well as wages. No one's wages would increase. No one wanted to ask for wage increases because it would be seen as impolite or just not the way that things are done. So that was the last part, trying to break some of these norms. So the monetary bazooka and the fiscal stimulus, those, they had pretty direct control over. Those all went through. The structural reform really didn't occur. But come COVID, this went on for the better part of a decade. COVID turned the world upside down. Inflation returned around the world. And in Japan, long praying for inflation, got to come along for that supply side shock. And now they've got inflation as well. So all that then brings about the question, what now? So another quick recap. After COVID hit, we had those big supply shocks, price increases pretty much globally that pushed up inflation pretty aggressively in the West. That in turn prompted a very coordinated, very rapid rate hiking cycle in the US from the Fed, in Europe from the European Central Bank, and from the Bank of England. In contrast, Japan, they saw the same inflation shock, but rather going from 2% previously to about 10% at the peak. I think they went something like closer to zero, I think up to maybe 4 or 5%, then it came back down. It wasn't seen as this huge inflationary problem in Japan. If anything, again, this was what they really wanted for so long. However, one of the kind of unwelcome side effects of this as well, there's huge change in the value of the yen globally. So we're talking about the global foreign exchange markets. The yen depreciated anywhere from like 30 to almost 40% against like all major Western currencies, against the dollar, against the euro, against the pound. And so just seeing that's one of the first big side effects of inflation's back. Japan wants it, the rest of the world does not. What's going to happen next? That kind of had a natural effect of depreciating the yen. They kept their interest rate just barely negative even instead of raising it. And they still kept going with their yield curve control as well. This happens because a certain currency, now that short-term interest rates like the dollar were quite high, they got as high as 5%. Someone now just holding dollars will make 5% just sitting on it. Whereas with the yen, you're not making anything. In fact, you're paying a very small amount simply to hold cash. So it was seen as a good deal to then take your yen, exchange them for dollars, and that exchange or earn that interest on the dollars, and then convert back to yen, and you're essentially pocketing that extra interest rate differential. In doing that, it causes the value of the yen to go down as more and more people jump into this kind of trade. And it's been self-reinforcing for the past few years now. Net effect, the Japanese yen against the dollar went from about 100 to 110 yen per dollar, now to about 150, 155 yen per dollar. So
damn.
Really drastic
50%
depreciation. Yeah.
A little less. But what's that called? Isn't there a name for that sort of trade? It's called the yen forward trade.
The carry trade.
Carry trade. Okay. I think I have heard about that. Yeah. People are just borrowing a bunch of yen. Yeah. Okay.
Yeah. And then the carry part is just, you just sit on it and you just carry that interest through and you just collect it and life is good.
Hedge fund people are so smart. It's just make it look so easy.
Exactly. That's all they're doing. That was one of the big things that blew up in July 2024, the yen carry trade, when people started to think this dynamic was going to end, but it didn't. people, things normalized again, and then
it's never going to end, Joe. Just keep putting them on. Let's keep doing it. Keep the good times rolling.
That's really what it seems like. And so that's really the next point here, which is now kind of the strange part. So over the past few years, or over that 2022 to 23 period, as the West was raising interest rates and the Bank of Japan was not, in the past 2 years now, we've now seen all of the Western central banks start decreasing rates anywhere from, like I think the US is now at 150 basis points lower than it was before. I think Europe's over 200 or so. And the Bank of Japan has finally started increasing their interest rates. They raised about 50 to 60 basis points, depending on your starting point. Whereas now the Western central banks have cut by, 3 or 4 times that amount. Just given my argument before, Luke, what should that do to the exchange rate of the yen?
Well, I guess everything else equal, it should strengthen it. Holding money at yen at Japanese banks looks relatively more attractive. That's all it is to it. And then start buying them up. Should strengthen it theoretically, but it sounds like you're setting us up for something.
Yeah, that's my big thing.
Oh, actually, hold on, I changed my mind. Well, actually, Joe, it's very complicated, but let me try to help you wrap your head around this. I actually have a prediction. I think it's going to weaken.
How do you know that?
Just reading the room. Here, Joe. You can learn.
That's exactly it. So all of these things now for 2 more years, everything has set up to look like it should start strengthening again, basically reversing these really aggressive depreciations over the past couple of years. But that just hasn't happened. In fact, it's weakened even a little bit further since then. So over 22 and 23, it was more straightforward what was happening. And, this is like we were saying, it's a well-known trade. All these hedge fund geniuses doing this for many years. It works really well. Fine. Like the trade still exists, but the way that markets have moved, given these new events, is basically the opposite of what everyone would have expected. And as of today, everyone's, it's not obvious. Everyone's kind of scratching their head somewhat. The real reason, or, the best kind of explanation that we have so far is the new prime minister. Luke, how familiar are you with Prime Minister Takaichi and Trump's little love fest that they had over in Japan last month?
This woman is a winner. The cherished alliance between the United States and Japan is one of the most remarkable relationships in the entire world. Our bond has grown over 8 decades into the beautiful friendship that we have. So I have to say this, the first female Prime Minister in the history of Japan. Madam Prime Minister.
After doing some research, I realized she was she was elected because she wanted to put forward this fiscal stimulus. I think I heard that somewhere.
Yeah. She was a political protege of Shinzo Abe, in fact. So right from the start, she's kind of seen as this continuation of Abenomics. It's a big reason in which she got elected overall. Fiscal stimulus. We got to keep going here. Print more money, cut taxes more, get people spending. But Luke, where's all this money going to come from?
So yeah, that was my next question. This seems like kind of straight. Is it going to be a fiscal or monetary thing? So is it coming from the central bank or is it coming from the government coffers? Are they borrowing against the central bank, or is somehow the central bank going to be doing it? That would be pretty wild.
It's going to come from more JGBs, more bond issuance, more debt for the country. They're just borrowing more. Japanese government debt.
Just for the audience sake.
Yeah. U.S. Treasuries, USTs, JGBs, Japanese government bonds.
All right.
So effectively, that's where the money's going to come from. Who's going to pay for that? People willing to buy them. Now, that's the interesting point that you brought up, though, Luke, is the central bank going to be involved here? That sounds a lot like quantitative easing. And at a time when the central bank has been tightening policy now for the past couple of years, very slowly, but they're tightening policy. How is that going to work out? kind of in a worst case scenario, if we see that they issue these bonds, interest rates rise even more, then it becomes more expensive. That's what Ray Dalio would say. We're kind of moving from that stage 2 to stage 3, where then the central bank is just kind of explicitly funding the government. If the BOJ gets out there and just starts buying up bonds again so aggressively, which they've done multiple times in the past so far, they're almost kind of known for being the most aggressive central bank to do that. It seems very much on the table at this point.
Kind of makes sense. Normally, you would fight against it because of the inflation thing, but if you want it, then yeah, just go ahead and buy them up.
Which is the tricky point, because if they already have the inflation today and their interest rates are now, like, I think their long end rates are almost up to like 3 or 4% now, and those long end rates before they yield through yield curve control, they were pinned at 0. They're way higher now. The cost of the Japanese government borrowing is substantially higher today, and the central bank is tightening, not easing.
Yeah, definitely not as obvious of a decision this time for the central bankers to just go ahead and buy it up if they're trying to tamp down inflation.
Is the Japanese government going to have this kind of bond vigilante moment that we talked about before? This is the thing that over Liberation Day, it's what finally pushed Trump to reverse course on his reciprocal tariffs. It didn't matter what the voters were saying, what other politicians were saying, what other countries were saying. All that mattered was the bond market. Similarly, in the UK, we've seen this a few times recurrent over the past year now, and in a particularly violent way in 2022, when Liz Truss, basically her premiership was completely ended in less than 2 months because of bond vigilantism. And all that comes back to just saying, borrowing more than investors believe you should be able to.
Oh, interesting. That's good context. Yeah, I forgot about that situation in the UK.
And which is still ongoing today. They're still trying to get it figured out, like in a really fragile position still. It seems like the US has stabilized quite a bit, especially with the tariffs. It's bringing in more income. But in Japan, everything is pointing in the opposite direction right now.
How big is the central bank? Just total assets?
I think the BOJ would be like over 100% of GDP in terms of their government debt holdings.
What if you just forgave that debt?
That's a good question, because I really don't even know what that would look like. Because usually when you think about debt restructurings like that, it's in the context of maybe smaller emerging market nations that they're beholden to other like large governments, and they kind of agree on a different payment system. That's what they did for Greece within the past decade. But for something as big as the United States or Japan, there's really no singular entity that they're answering to. You know what I mean? It's,
I mean, just even like
global.
Yeah, but I'm just talking about what if you just said, look, 10% or something, 10 billion, start small, just forgive it. Don't worry about it. Don't pay it back.
Yeah. And, it's so obviously those people holding that 10 billion of debt, they're going to say, WTF.
But that's the central bank.
And then once you do that,
WTF all they want.
Well, right. And then other bondholders, though, they're now going to see, wait, if it happened to the central bank, it could happen to me.
No, the central bank is their choice.
Right. And they're doing that presumably to help continuing to fund the government. Right?
Yeah. Lower the
through that
GDP
line of
ratio.
reasoning. Yeah. So any other bondholders out there, they're saying this is not a good dynamic. We probably won't get caught up in that, but I am now incentivized to take a step back from this debt. And it doesn't take, relatively that many people to have this kind of bond vigilante moment, just this really concerted, sharp move in pricing. It kind of grinds all that to a halt. It kind of tells the central bank, actually, wait, this is a gimmick. This is not really going to work. As a result, it usually just doesn't get that far, because it just quickly turns into a very ugly kind of backdrop.
Try it. All right, fine. Point taken.
It's possible. Yeah, no, I mean that's like the other big thing here. It's like we're at this turning point right now.
So, all right, make a prediction. I'm starting to make some predictions here. You think she's gonna, the bond vigilantism or whatever is gonna take hold, and she's gonna get kicked out in a couple weeks, months? You think it's going to bounce back? You think this is going to work? I mean, what is the measure of success for her? Is it growth? She's looking at GDP growth, like real GDP growth. She's not looking at inflation. She's not looking at debt-to-GDP. She's looking at just straight up growth.
Yeah, I think growth and inflation still.
You think it's going to work? What should we look out for? What do you think?
The UK is kind of the closest thing that we've seen to this in such a crazy way, within the past few years. And that happened like soon after these announcements were made. So I think so far we know it's not going to be that bad, because I think just about a week ago already, the Prime Minister announced the plans for this fiscal stimulus. So I think the number's 21.3 trillion yen, massively bigger than anything that we've seen in the past outside of COVID. The markets now understand that this is coming. It's going to come from bond issuance. So everyone already knows all these things that we're just talking about. And things haven't exploded. Obviously she's still in office. I think in the UK, if it would have been like that, she kind of already would have been in, extreme crisis mode and on her way out. But that's just not the case. So far, for whatever reason, the bond market seems to be relatively more forgiving so far to Japan than the UK. That said, really, it's the interest rates that are going to be one of the core things to watch as all of this gets going. Auction sizes of JGBs are going to increase. That's a fact. That's how this is going to be paid for. The next thing I would watch is how much more, if any, are interest rates increasing due to these larger auction sizes. That's kind of like the first, very on the ground, very specific view of how's the market responding to these new plans. But then we're back to the question, how high can they go before this becomes a problem? In the UK, that was about 5%. Japan's getting pretty close to that. But like we said, hey, 5% in Japan might not be anything like 5% in the UK.
And that's kind of like the number that feels like the number that we sort of talk about here. I know we've got like CNB, like at work or something, we got, news going and stuff. And I remember when, 10-year started to like pass up 5%, it was newsworthy. Like that was a big problem. And then he gets back down to 4 and stuff and 3. And you're like, okay, okay. Whew. 5% seems to be like the kind of the bad number.
Like the US 10-year, it's been around 4% all year long now. It's been gradually falling. But yeah, end of last year, it very briefly touched 5%. And yeah, people did start to freak out a little bit then. But it didn't last. So that would be one of the next big things I would watch.
Okay, interesting.
Yeah, so the 10-year JGB is at 1.83% still. So relatively speaking, that's like almost nothing. But their super long end debt, so the US tops out at 30-year. Japan has a 40-year bond. That's the one that's really increased quite a bit. So that one's at 3.71 right now. And that's been newsworthy because that's been, I don't know if it's the highest it's ever been, but it's been the highest, I think, since that, the beginning of these lost decades.
Who buys those? Do they think that like it must have some sort of play on the, not just the interest rate, but also a play on that the yen is going to strengthen like a lot?
Yeah, I mean, a lot of times this super long end debt, it's not so it's like you do have speculators like hedge funds saying, here's what I think about the rate 40 years from now, that kind of thing. Usually, though, it's like pension funds and stuff like that, just people that are just lining up cash flows over like really long, over decade periods of time. So they just kind of structure these things so that I don't have to buy a new bond every year. I buy a 40-year. I structure the rest of my portfolio around that to meet my liabilities. And we're good. So that's like a very common pension fund thing, for example. And that happens around the world.
Yeah. I guess it could also be just, managing for banks and other things, duration, stuff like that.
Yeah, that kind of stuff. This is more like utility financing almost.
Okay.
Meeting your liabilities for a pension fund, structuring your duration exposure, like you said, for banks.
Man, I don't know, man. I mean, that's a lot of duration at a really low interest rate. Like that's nuts. Because what we mean here is like if interest rates go up at all, then all of a sudden the value of that bond tanks. And it's like it can only go up. The interest rates can only go up. So you're just sticking with this thing.
I think that's a reflection of just how crazy the times were for these past decades. In Europe, interest rates were even more negative. I'll have to see if I can pick up this actual bond as an example, but I think Austria, they issued this 100-year bond, and they issued this thing in like the middle of 2021 when no one was even dreaming of inflation yet, and interest rates were back at zero. This thing is like a 1% coupon or something like that for 100 years now. Now interest rates are 4 or 5%, and there's whoever bought this thing. I think the price on the bond, issued around 100. I think the price is like 30 cents now. It's lost like 70% of its value.
Right.
Some poor pension fund out there is now sitting on this thing for a century of just like.
I hope they didn't buy too much of it. Oh, that's fucking brutal.
That's a sign of the times. When those times have changed quite drastically. Japan's now catching up. Interest rates are rising. They've been slower than they were to rise than in Europe and the US. Inflation's rising. It was slower than it was in Europe or the US. We've got the inflation now. We've got the higher interest rates. And now we've got this continuously increasing in scale fiscal stimulus. Where do we go from here?
All right, interesting. All right, Joe. Yeah, thanks for the briefing. I feel like now when I see that kind of pass over my feed, I'll have a little bit better sense of what's going on.
I wanted to structure this as a, kind of a, hopefully quick, hopefully not too dense, but kind of like an intro to all these ideas. Because, in my view, this is going to come up increasingly so over the coming months. So this is something that I'd definitely like to return to whenever something does, hopefully not, but potentially blow up or, something crazy like that.
Yeah, definitely. Yeah, no, this is a good story to follow, especially with that context of the previous PM from the UK. Yeah, kind of definitely piqued my interest. And then, see what the rates are going to do. All right, cool. Thanks for getting us up to speed.
With that, thanks for tuning in. This has been the Root of All Evil podcast. I'm Joe.
I'm Luke.
And we'll see you next time.
See ya.
See ya.
Bye.